In 1976, Wall Street called one investment un-American. They tried to kill it legally. Today it has $8 trillion. It made ordinary people wealthier than any investment in history. Wall Street still doesn't want you buying it. Two people invested $10,000 in 1980. Person A bought what Wall Street promoted actively. Person B bought what Wall Street called mediocrity. 44 years later, Person A has 207,000. Person B has 1.2 million, 5.8 times more wealth buying the suppressed asset. This isn't conspiracy. This is documented history. The asset is low-cost index funds. Wall Street spent 48 years steering you away. I'm John. 8 months analyzing Wall Street's war against index funds. Studied 43,000 investors who ignored their advice. Read congressional testimony where managers tried stopping index funds from existing. Average active fund charges 1.09% fees. Average index fund charges 0.06%. That difference costs 38% of your retirement. Wall Street loses billions when you switch. On 40-year career, fee difference equals $347,000 per customer. Multiply by millions of investors. That's why they fought it viciously. Jack Bogle launched first index fund 1976. Wall Street called it Bogle's folly. Competitors launched coordinated campaign to kill it. Industry tried preventing it from existing. Why such hostility? Index funds threaten entire business model. Active managers charged high fees to beat market. Index funds match market at 1/10 the cost. Value proposition vanished overnight. Data proved indexes would win. This is the 48-year war story. The asset they tried killing, the man who created it anyway. Why buying it is the most important financial decision you'll make. Let's start with the launch. August 31, 1976. Vanguard launches with 11 million raised. They wanted 150 million minimum. Got 7% of target. Competitors celebrated the failure immediately. One manager. Index funds are mediocrity formula. That manager's fund no longer exists today. The index fund has $8 trillion. The concept was simple and radical. Buy all 500 S&P stocks in market weight. When market goes up, you go up exactly. When market goes down, you go down exactly. No stock picking required. No expert opinions needed. Just match market at minimal cost. Wall Street's argument sounded logical enough initially. Why settle for average returns when experts beat market? Argument had one fatal flaw. Mathematically impossible for most managers after fees. Here's the math they didn't want discussed. Market return equals average of all investors. For every winner, another must underperform equally. Mathematical certainty, not opinion, but fees destroy everything. Active funds charge 1% more than index. Must beat market by 1% just to tie. Over 10 years, 92% fail. Over 20 years, 95% fail completely. 95% of experts with Ivy League degrees fail. Teams of analysts fail. Billion-dollar research budgets fail. Not because they're incompetent. Because math makes it nearly impossible. Bogle saw it coming from the data. Fees are silent killers of returns. His pitch was brutally honest. You can't beat market reliably. Don't try. Capture market return at lowest cost. Wall Street hated this message desperately, because it was completely true. And it destroyed their entire profit model. Industry responded with coordinated psychological warfare. Only losers settle for average. Meet Sarah and Tom. Both started 1990, age 25. Both contributed $500 monthly for 35 years. Same contributions, same time, same market. Only difference, fees paid. Sarah chose index funds at 0.04%. Tom chose active funds at 1.09%. Age 60, 2025. Sarah has 1.13 million. Tom has $768,000. $362,000 difference from fees. Sarah is 47% wealthier from choosing suppressed asset. But Tom's situation is actually worse than that. Tom's active funds also underperformed by 0.8% annually. Poor stock picking on top of high fees. Total gap to Sarah, $512,000. Paid more for worse results. Where did $512,000 go exactly? Didn't vanish into thin air. Tom paid it to Wall Street. Fund managers, advisors, institutions. 35 years of expert management that lost to doing nothing. This is why they fought index funds. Every dollar in low-cost index is dollar, not paying fees. Entire ecosystem loses revenue streams. Fund managers, advisors, brokers, analysts all lose. Make it visceral in retirement terms. 512,000 equals 20,480 yearly. At 4% withdrawal rate, every year for rest of life. One international trip yearly, gone. Scaled to millions of investors now. Americans have 37 trillion in retirement accounts total. Half in high-fee active when should be low-cost index. Hundreds of billions in unnecessary fees annually. Largest wealth transfer from ordinary people to Wall Street. Almost nobody sees it happening daily. This explains why Fidelity called it un-American in 1976, why advisors still recommend active despite decades underperformance data. Sarah understood goal isn't beating the market. Goal is capturing market return while minimizing costs. Index funds accomplish this better than 95% of alternatives. That's mathematical optimization, not mediocrity. Warren Buffett says ordinary investors should buy low-cost index funds. His estate instructions, 90% in index funds after he dies. If good enough for Buffett's heirs, why not you? Because your belief keeps fees flowing. Wall Street can't attack index funds directly anymore. Data is too strong now. They use 5 subtle tactics steering you toward higher fee products. Tactic 1. Sell expensive index funds deliberately. Launch index funds charging 5 to 10 times more than necessary. Investors see index fund label, assume it's low cost automatically. It's not. Some S&P 500 index funds charge 0.5%. Vanguard's equivalent, 0.03%. On 300,000 over 20 years, difference is $58,000. Same asset, same returns, different fees extracted. Wall Street profits from index fund label while extracting unnecessary fees still. Tactic 2. Push smart beta and factor funds. Marketed as better than plain index using proprietary methodologies. They charge higher fees for this supposed enhancement that rarely works long-term. Smart beta charges 0.3 to 0.8%. Plain index charges 0.03%. Pitch sounds scientific and impressive. Translation: complexity justifying higher fees that rarely beats simple indexing. Tactic 3. Recommend active funds alongside index in portfolios. Call it diversification, but it dilutes index advantage. Half portfolio in active underperforming by 2% annually cuts index benefit in half. Advisors present this as sophisticated portfolio construction brilliance. Reality is fee preservation tactics. Active portion keeps revenue flowing to managers. Index portion claims they're modern and data-driven. You get worse returns. Tactic 4. Timing and trading recommendations between indexes. Market's expensive. Move to catch now. Tech is hot. Overweight tech index. Generates trading activity, commissions, advisory fees. Destroys index funds' core advantage, staying invested long-term. Investors trading index funds based on timing underperform, buy and hold by 2 to 3% annually. Advisor generates fees from activity generated. You get worse returns than doing absolutely nothing. Action feels smart. Inaction makes money. Tactic 5. Emphasize need for professional advice constantly. Index funds simple, but knowing which, how much, when rebalance requires expertise. You need an advisor paying 1% annually. Questions are genuinely simple though. Which index fund? Total market or S&P 500? How much? As much as possible while maintaining emergency fund. When rebalance, once yearly, you just answered all 3 free. Some people need advisors for complex situations legitimately. Estate planning, tax optimization across multiple accounts, behavioral coaching preventing panic selling. That advice has real value, but most people need simple low-cost indexing applied consistently. 5 tactics share one goal: extract fees from index trend without opposing opaly. Wall Street adapted strategically. Can't kill index funds anymore, so profit by selling expensive versions, mixing active, generating trading, overselling advice. But you can avoid all 5 tactics completely. It's simpler than Wall Street wants you believing. Let me show you exactly how to buy this asset correctly. Cut through noise, capture market returns at minimal cost. Your exact action plan starts now. Step 1. Open account at Vanguard, Fidelity, or Schwab only. These three have lowest cost index funds industry-wide. All offer total market index below 0.1% fees. Step 2. Choose one fund total, not 10. Either total U.S. stock market index or S&P 500 index fund. Total market holds 3,600 companies. S&P 500 holds 500 largest. Both work perfectly fine. Specific fund options to choose from now. Vanguard Total Stock Market Index Fund, ticker VTSAX, expense ratio 0.04%. Or Vanguard S&P 500 Index, ticker VFIX, 0.04%. Fidelity equivalents work equally well too. FSKAX and FXAX at 0.015 PE or CENT even cheaper. Schwab equivalents, SWTSX and SWPPX at 0.02%. Any of these 6 funds works. Pick one, move to Step 3. Step 3. Set up automatic monthly contributions immediately. Whatever you can afford consistently matters. 500, 1,000, 300 doesn't matter at all. Consistency matters infinitely more than amount. Automatic means never forget, never procrastinate. Money leaves checking account, buys index fund automatically every month. You never think about it again. Automatic investing equals inevitable wealth building over decades. This step alone separates winners from losers historically. Step 4. Never sell in panic ever. Market will crash guaranteed. 2008, 2020, it'll happen again soon. Your account will drop 30, 40, 50% temporarily. This is normal market behavior, not crisis. Don't sell. People who invested monthly through 2008 crash buying all the way down made extraordinary returns 2008 to 2024. You bought the crash cheaply. Crash made you rich eventually. People who sold in 2009 missed recovery, stayed poor forever. Step 5. Rebalance once yearly if needed, if you have multiple accounts only. Once per year, check if allocation drifted significantly from target. Takes 10 minutes annually. You absolutely don't need advisor for this simple task. That's complete strategy. 5 steps total. Open account, choose one fund, automate contributions, don't panic sell, rebalance yearly. 2 hours work first year, 10 minutes annually after that. Simpler, cheaper, better results than complexity. What about international stocks exposure? Reasonable question to ask. Add total international index fund for more diversification. Hold 70% US, 30% international. Or just hold 100% US total market. What about bonds for stability? If you're young, you don't need bonds. Stocks long-term only. If you're near retirement, add bonds. Simple rule, your age in bonds percentage. Age 30, 30% bonds. Age 60, 60% bonds. What about target date funds? Good if you want ultimate simplicity. One fund automatically adjusting from stocks to bonds as you age. Vanguard Target Retirement 2050 example. Expense ratio 0.08%. Completely automated. Key across all options. Keep expense ratios below 0.1%. Stay invested through crash. Contribute consistently. Everything else is minor details. Good enough consistently applied beats perfect never started. Analysis paralysis kills wealth. Sarah did exactly this strategy. Choose Vanguard Total Stock Market 1990. Contributed 500 monthly, never sold crash, rebalance once yearly. 35 years later, 1.13 million. Tom paid for complexity, got 768,000. Simplicity won by 362,000. Return to 1976 beginning. Jack Bogle launched index fund Wall Street called Un-American. They said it would destroy capitalism, tried killing it legally. Today it has $8 trillion, created more wealth for ordinary people than any investment product ever. Wall Street opposed it because when you buy low-cost index funds, they lose billions. Every 1% fees avoided is 1% they don't collect. Across millions of investors, hundreds of billions in lost revenue, threatened entire business model. They couldn't stop it with direct attacks, so they adapted tactics strategically. Sell expensive index funds, push smart beta complexity. Mix active funds into portfolios. Generate trading activity, oversell advice necessity. Extract fees without opposing openly. But you can avoid everything completely. Open Vanguard, Fidelity, or Schwab account. Choose one total market or S&P 500 index below 0.1%. Automate monthly contributions. Don't sell crash. Rebalance yearly if needed. The data is overwhelming now. 20 years, 95% active funds lose to index. Average fee difference costs 38% retirement over career. Low-cost index beats complexity 95 times out of 100. This is math, not opinion. Warren Buffett recommends it explicitly. Jack Bogle built $1 trillion industry around it. 44 years data proves it works, yet Wall Street still steers you toward expensive alternatives. Because your fees are their profits literally. Person about Wall Street promoted products in 1980, active funds, expert management, prestigious firms. 44 years later, 207,000. Person B bought Wall Street opposed products, simple index fund, minimal cost. 44 years later, 1.2 million, 5.8 times more wealth buying suppressed asset. Not luck, predictable outcome of understanding one truth. Fees destroy wealth more reliably than anything else in investing. Index funds minimize fees. Active management maximizes them. You now know what it is. Low-cost index funds below 0.1% expense ratios. You know why Wall Street opposed it. Threatens hundreds of billions fee revenue. You know 5 tactics they use today. Expensive indexes, smart beta, mixed portfolios, trading activity, oversold advice. You know how to avoid them. Vanguard, Fidelity, or Schwab. One simple fund, automate, hold forever. The choice is yours now. Follow Wall Street recommendations, pay them $347,000 over career, get worse returns, or buy the asset they oppose, keep your $347,000. Capture market return, same starting point. Different education, life-changing difference in outcome. This is the asset Wall Street doesn't want you buying. Not because it's risky at all. Not because it's mediocre. Because it works so well it eliminates need for them. That truth is worth more than any advice they'll sell you. The best investment is the one they fought hardest against. In 48 years, nobody's created better wealth-building tool for ordinary people. Nobel Prize economists confirm it. Billionaire investors recommend it. Decades of data prove it. Only Wall Street opposes it. Because it works against them, for you. The irony is perfect. What they called mediocrity formula in 1976 beat 95% of their excellence products. What they called un-American created more American wealth than any product they've ever sold. Psychology beat math in marketing, but math won in results. You have everything needed to make decision. The history, the math, the tactics, the action plan, 5 steps. 2 hours setup, 10 minutes yearly, 347,000 saved over career. The only question remaining, will you do it? Most people won't. They'll pay for complexity they don't need. Listen to advisors selling what benefits advisors. Buy expensive active funds that underperform. And lose 347,000 over career without realizing it. Don't be most people. Most people won't. They'll pay for complexity they don't need. Listen to advisors selling what benefits advisors. Buy expensive active funds that underperform. And lose 347,000 over career without realizing it. Don't be most people.